The housing market is broken. Everyone agrees on that. So the banks have a solution: the 50-year mortgage. Lower monthly payments, more affordable home ownership. Problem solved, right? Wrong. I'm Terrell Higgins, and in today's video, I'm going to be breaking down why the 50-year mortgage is complete financial garbage. I'll show you the math, how it's going to affect home prices, and most importantly, I'm going to show you a path to home ownership that doesn't involve you paying a mortgage until you're 88 years old. Let's get into it. Before we talk solutions, we need to acknowledge that the problem is legitimate. We are missing millions of homes. The US has a shortage of somewhere between 1.5 and 5 million homes. So the market isn't just missing buyers, it's missing doors. And here's the kicker. People who purchased at those all-time low interest rates of 3% or lower in 2020 and 2021, they're not selling. They're sitting tight. Why trade up from a 3% to a 7% mortgage? And this lock-in effect is crushing inventory to historic lows across the country. And buyers are getting older. The average age for a first-time home buyer is 40 years old. And for repeat buyers, the average age is 56. These are both all-time highs. If you think about it, if you signed up for a 50-year mortgage at 40, you don't make your final payment until you're 90. You're signing up for a contract that is probably going to outlive you. Housing affordability has absolutely collapsed. So now 43% of the median household income is required to afford the median price house. Historically, it was between 25 and 30% of the median household income. So this isn't some sort of short-term hiccup in the market. This is a structural change. So there are large problems at play here. But extending loan terms to 50 years is not the solution. So let me show you the numbers comparing a 50-year mortgage to a 30-year mortgage. And we're going to use current market data. So the median home price right now is $419,200. If you do a 20% down payment on that home, that's $83,840. So your loan amount is going to be $335,360. Now, if we compare these two loans for a 30-year fixed mortgage at 6.25%, your monthly payment is $2,065. Your total interest paid across this 30-year loan is $408,000. So your total cost of the loan is $743,360. Now let's compare this to a 50-year mortgage. And note, since 50 years is longer than 30 years, your interest rate is going to be slightly higher because that's more risk to the bank. So for this 50-year fixed mortgage, we're going to assume your rate is 6.75%. So 0.5% higher than the 30-year mortgage, which I think is pretty reasonable. Your monthly payment is going to be $1,970. Your total interest paid is going to be $846,000. And the total cost of your loan is going to be $1,181,360. So let's break down what you're actually trading for here. A monthly savings of $95 between the 30-year mortgage and the 50-year mortgage. That's it. The cost of dinner and a movie once a month. And for that $95 worth of savings, it's going to cost you an additional $438,000 across the life of the loan. The total cost for that 50-year mortgage is 43% higher than a 30-year mortgage. And the total interest payments are nearly double what you would pay on a 30-year mortgage for a very marginal reduction in your monthly payments. But here is where the problem gets even worse: building equity. So on any mortgage, because of the way amortization works, you end up paying more towards interest than principal for a lot of the early payments. And there's a crossover point where you actually start paying more towards principal than interest to the bank. But the time frame actually matters. So for a 30-year mortgage, that crossover point happens year 18 and a half. That's 222 months into your mortgage. And then for a 50-year mortgage, it's year 38. So let's talk about what this means in practice. So most people sell their home at the 10-year point. So let's see where you stand after a decade. On a 30-year mortgage, you've generated a substantial amount of equity. You own about 25% of your home. On a 50-year mortgage, you have almost no equity. You only own about 8% of your home. So you are functionally just renting your home from the bank, and you paid them a substantial down payment to do so. And if you think about the transaction costs for closing and realtors when you sell a house, if there was any sort of market decline in there, you would actually be selling your home at a loss, or you would have to contribute additional money just to move out of your home. So if you thought the market was locked up because of these 3% mortgages, introducing these 50-year mortgages will make it even worse, because there's no universe where people are going to pay money to move out of their homes. So if the 50-year mortgage was such a great solution, why isn't it here already? And there are two major obstacles to this. So after the 2008 crash, the Dodd-Frank Act introduced something called the qualified mortgage rule. It limits safe mortgages to terms of 30 years or less. And if a loan is outside of these frameworks, then there's no legal protections for the lender if the borrower stops paying on the loan. So banks are very hesitant to issue loans without that protection. The second reason is Fannie Mae and Freddie Mac. These two government entities actually purchase 70% of all the mortgages in America. And their legal charter requires them to purchase loans of 30 years or less. So the translation here is that Congress would have to change the charter of Fannie and Freddie to accept loans that are greater than 30 years. So if you are shopping around and you see a 50-year mortgage somewhere, just know that they're going to charge a very large premium on that mortgage, because they can't sell it to Fannie Mae and Freddie Mac, and they don't have any protections from the qualified mortgage rule. So these 50-year mortgages are terrible, but don't take my word for it. Let's look at some other countries that have already tried to implement them. So in Japan, they have 50-year and even 100-year mortgages that are designed to get passed down between generations. But here's the problem. The housing market in Japan is deflationary, which means their homes actually lose value over time. So when you pass down that house from one generation to the next generation, you're not passing down wealth. You're just passing down debt that someone has to repay to the bank. So recently, the UK floated the idea of introducing a 50-year mortgage to help their young home buyers. And it was widely criticized as a band-aid that was going to inflate home prices instead of fixing the structural issue of not having enough housing supply. See, when you make the loans more affordable, the sellers just jack up the price. So you're not actually making anything more affordable. You're just increasing the amount of debt that young homebuyers would have to take out. If you remember, we saw something very similar here in the United States with auto loans. So when auto loans shifted from 48-month loans to 72 and subsequently 84-month loans, what happened to car prices? They skyrocketed. Why? Buyers don't care if the house costs $400,000 or $500,000, as long as they can afford the monthly payments. So sellers would immediately raise their prices, spiking home prices across the United States if these 50-year mortgages were introduced. That $95 in monthly savings would immediately evaporate, and then some. So now let's play this out to its logical conclusion. So you're 38 and you take out a 50-year mortgage. You're making payments until age 88. But the problem is most people retire at age 65. So you've retired, no income's coming in, but you still have to make another 23 years worth of payments. So what are you going to do? Are you going to continue working into your 80s to make these payments? Are you going to start drawing money out of your retirement funds to continue making these monthly payments? Or are you going to do a reverse mortgage? So a reverse mortgage means that you slowly start giving back your home to the bank in exchange for a payment to you. So we've come full circle here. You spent nearly 50 years paying money on this house to the bank, only to give the house back to the bank in the end. You never really owned the home. You were just engaged in this long rental agreement. But here's the hard truth. We're solving for the wrong variable here. Everyone's focused on extending time to try and lower the monthly payments, but we really need to be focused on price. Let me show you a different path. Banks charge different interest rates based on the loan length. Longer loans have higher interest rates because they carry more risk for the bank. So a 15-year mortgage is going to have the lowest interest rate because it's the fastest payback period for the bank. A 30-year mortgage is in the middle, and a 50-year mortgage is going to have the highest interest rate because you are borrowing money for half a century. Now, this is critical. You aren't just paying on this loan longer, you are paying a higher rate just for the privilege to pay longer. Now let's compare these three different loan types across the same loan amount. So if you take out a loan of $335,000, if you look at this table, comparing these three different loans, what you will notice is that you end up spending $688,000 less on your home using that 15-year mortgage compared to your 50-year mortgage. But Terrell, my monthly payment is $770 more with that 15-year mortgage compared to the 50-year mortgage. But here is why it is worth it. This is what you gain. So 10 years into these two mortgages, on that 15-year, you've built a substantial amount of equity. So that natural point where you want to sell your house, you're going to be raking in a bunch of cash. But on a 50-year mortgage, you might have to pay money just to move out of your home. And at the 15-year point, your home is paid off. You have freed up that money in your monthly budget to do whatever you want. On a 50-year mortgage, you still have another 35 years of payments to make. And when it comes to retirement, on that 15-year mortgage, you've owned your house outright for years and years, and you don't have any mortgage payments eating into your monthly fixed income. And that 50-year, it might not even be paid off, and you might have to give it back to the bank. So this is a mindset shift. The 50-year mortgage is surrender. It's admitting that you will never actually truly own your home, where the 15-year mortgage is financial freedom. It is hard at first, but it ends. And when it ends, you have a chance to build a substantial amount of wealth for yourself by not having those large monthly payments. Look, I get it. You might not be able to afford a 15-year mortgage on the home that you want, but you might be looking at the wrong home. The housing market is broken right now, and we have normalized buying homes at the ceiling of what we can afford. The bank pre-approves us for a certain loan payment each month, and we shop to the very edge of what we can afford. But home affordability is more than just a loan. It's about building equity in your house. It's about having a cushion to deal with emergencies. It's about actually owning the home one day and being able to retire without a mortgage. And one strategy that I use to afford a 15-year mortgage is actually splitting those payments into bi-weekly payments. So it lines up with your paycheck from work, and that slight increase in payments is split across the month, so you barely feel it. I actually did an entire video on how a 15-year mortgage with split payments is going to save me over $300,000 and help me own my home in 12 years. So here's the real takeaway. 50-year mortgages will be marketed as the solution to the housing crisis. Lower monthly payments, more buyers, everyone wins. But 50-year mortgages are not home ownership. It's just a subscription to a house that you will never fully own. And 50-year mortgages aren't going to construct a single new house. It's only going to push up the prices on existing home inventory. So we don't lack cash here, we lack doors. And no amount of financial engineering is actually going to fix the shortage of doors in the United States. And if today's video transformed the way you think about mortgages, like the video, subscribe to the channel, and share it with someone else who would get some value from it. Because I'm here to transform your finances and not just give you more talking head information. Keep getting 1% better every day, and I'll catch you in the next video.